Hey everybody, thank you so much for checking the channel out. My name is Agabus. This is your financial education channel. If you like what you see today, please make sure to like button below to support the channel. Subscribe if you want to see more content, and make sure to hit the bell notification to get notified every time we upload videos. Today we're talking a bit about the bond market again, but we're going to go over to Japan today to take a quicker, deeper dive into what is going on in the Japanese bond and debt markets. The first article today is from the Business Times. Biggest sell-off in 25 years hits Japan bonds as Bank of Japan loosens grip. Now, a little context here before we dive into the article. Just a reminder, when interest rates go up or go down, the value of the bond does the opposite, like a seesaw or a teeter-totter. So if Japan decides to raise interest rates, then the value of the bond you're holding is going to go down. Same is true to the extent when interest rates go up, the value goes down, which means that the yield or the return on that bond now has to go up as well. So it's a little bit of a counter or an inverse, and it's a little bit confusing. But when yields or the return you get goes up, that means people are selling or getting rid of the bond, and so the value gets depressed. The yield has to go up to entice people, investors, to come in. The article says Japan's government bonds are set for the worst quarterly sell-off in more than 2 decades as the central bank loosens its grip on the market. That's a reminder for investors that the nation's debt market relies in part on support from public sector institutions such as the Bank of Japan to outperform global peers. The securities have lost 3% in the third quarter, which is the biggest drop since 1998. According to Bloomberg. Our government bonds globally have also slumped during the same period due to the inflationary pressure that is seen across the world. Speculation is growing that the Bank of Japan will end its negative rate policy early next year, which means it will increase interest rates, even as its leaders say that stimulus needs to be kept in place to support a still precarious economic recovery. The idea of stimulating the economy is to print more money or expand the money supply. Bets on the Bank of Japan shift to tighten, and a global rout in debt caused Japan's benchmark 10-year sovereign debt yields to rise to a decade high this week, and the 30-year rate to the highest since 2013. Again, when these sovereign debt yields rise to decade highs, it means people are dumping or selling the bonds in anticipation, or so we could assume, that interest rates would go up, so they don't want to see losses on their bonds before the interest rate change. The article continues, just as investor concern that the Bank of Japan will reduce easy money caused by bonds to tumble this quarter, one institution that traders said may have triggered the late '98 crash was the Ministry of. Back then, the ministry said it would stop outright purchases of long-term government bonds on behalf of the post office, saving some post office or the public pension funds because it needed to keep cash to pay for tax cuts and stimulus measures. But the timing was bad. The ministry had also said it planned to sell a record amount of debt in the coming fiscal year, and prospects of a flood of new bonds hitting the market caused the 10-year yields to surge 180 basis points in 5 months from a low in September of '98. The article says here bonds due in 20 years and longer have led the sell-off in the third quarter as their yields climbed almost 50 points. Again, some people are trying to front-run the idea if the Bank of Japan increases interest rates and you're holding these long-duration bonds, you're going to have your price depressed, so people are dumping them ahead of time to try to avoid those losses. The second article we have is taking a deeper dive into what this yield curve control really is. This is from the Washington Post. Again, a yield curve is the idea that the longer you tie up your money for, let's say 30 years, you should get rewarded and have a higher interest rate or higher return than, say, a 6-month or 1 year or 2-year tie-up. You should have a lower interest rate. Now, when interest rates are moving and changing around, they tend to change around on the short end of the stick, So if you could get 5% on a 2-year bond versus 3% on a 30-year bond, that will change the behavior of investors to think, well, there's no reason to invest long term because the outlook for the country or outlook for taxes or outlook for anything isn't very rosy. This article, again, is from the Washington Post. It says there's an increase in speculation that the Bank of Japan's yield curve control policy days are numbered following the bank's surprise decision on July 28 to loosen its grip over the yields. Given the policy role as a pillar of Bank of Japan's efforts to suppress interest rates and stimulate the economy, the move prompted investors to wonder if more drastic changes might be coming. While the Bank of Japan denied any shift as planned, the July decision sent a shudder across markets, underscoring the challenge the Bank of Japan governor faces as he tries to phase out the policy without triggering market turmoil and an economic shock. Again, it's very tough to try to manipulate and manage the money supply if you believe it's okay to expand and contract that. So when people start to get even a whiff or a sense that you're going to start contracting the money supply or increase in interest rates, there is a ripple effect through the bond and the debt market. Now, an article came through the desk this morning and says Bank of Japan hikes bond buying as benchmark yields hit decade peak. Again, if the Bank of Japan is buying the debt, it's trying to keep those yields within line. Going back to that yield curve idea we discussed earlier, you should be rewarded for holding your money in an account or an investment for longer versus in the short term. So trying to manipulate this yield curve without crashing the market. The Bank of Japan said Monday it'll conduct on Wednesday an unscheduled and unspecified amount of additional purchases of Japanese government bonds with tenures of more than 5 years and up to 10 years. For those wondering, the Bank of Japan now holds a record 53% of Japan's government bonds. That's significantly higher than the Federal Reserve. That's significantly higher than United States' bank, the Federal Reserve, which only holds about 20% of those bonds. The issue that the Bank of Japan is running into is this idea of expanding and stimulating an economy through monetary policy, or the idea that you can help the economy by printing and creating more money. As you can see in the Bank of Japan, total assets that the central bank held 10 years ago was about $1.3 trillion. And as of January of 22, it has expanded more than 5x. And Japan's expansion is significantly higher than the balance sheet of the United States central bank. As you can see here from 2012, 2.9 expansion for the last 10 years of 2022, that was roughly a 3x. So Japan is heading into a very hard time because they've printed so much money. They've been manipulating the money supply so much that now they are in either a debt spiral or what some would call a rock in a hard spot. We hope that they're able to manage this debt spiral that they're coming into without crashing the total economy or creating an extreme inflationary environment where the rates jump up significantly and offshore or foreign money floods back into the country, again creating a significant inflationary effect. Thank you so much for watching. This is just developing here, some big changes again from the Bank of Japan and their monetary policy. We'll keep an eye on this. Thank you so much for watching. If you like what you saw, again, make sure to like button below. Subscribe if you want to see more content. Stay inquisitive, stay informed, and stay subscribed for more. We will see you tomorrow.